Me and my husband keep joking about entering a famous radio competition where you can win $500,000 each week. And we sat down and thought, oh, what would we do with that? Would we pay off the mortgage, put more in our pensions, spend some, invest some? Where would we invest it? And whilst the reality of winning this money isn't super likely, of course, somebody will win it, actually it got me thinking about a really key investing question. Because I find that most people have this issue of a prioritization problem. Whilst many of us won't have the nice problem of winning $500,000 and deciding where to put it, actually we'll always have the bigger problem, which is that any money that we do earn and have, we need it to work hard for us, and we need it to be in the most efficient places possible. Because if you're not prioritizing your account order and decisions well, then your journey to financial freedom and growing your wealth is going to be harder than it needs to be. So in today's video, I'm going to make a list and run through the best prioritization order for your investing and your financial priorities to hopefully make it as simple as possible no matter where you are in the world. Hi and welcome back. My name's Zoe and this is my channel Words on Wealth. As a former wealth manager, I break down key investing topics and headlines to try and make you a more confident investor and show everybody that you can have a life alongside also having some fun with your investments. So in the financial prioritization list, I'm going to start with the real basics, taking us to step one, which is really simply controlling your cash flow. Don't check out this video now. I promise there's going to be so much more about investing, but I have to start with it. I have to say I've seen super high earners that spend more than they earn, even at really, really high tax brackets. Get this under control first and make sure that you're not spending more than what's coming in. And crucially, you know that there is money set aside to be investing. That's it. Done. I promise. Priority number two is your emergency fund. And this is normally around 3 to 6 months of expenses that you hold in cash. Now, some people will be really groaning at this because the idea of holding 6 months of expenses in cash might be a little bit painful when you're here to think about investing. And it's true. In which case, split it up. Have 3 months that's super accessible and accept that it will be languishing a little bit with the interest rate versus inflation and long-term growth. And have another 3 months that is locked away on a fixed term account, certificate of deposit, whatever it is that is available to you in your country that ekes out a little bit of extra interest in exchange for being locked away. Normally people don't need 6 months of expenses overnight, but they might need them if, for example, they're in a more volatile industry or if they lose their job and struggle over time to get a new one. Now, priority number three is all about pension matching. And we're starting to get into the meaty stuff now. I've always through those first steps because I want to get into what are the really tricky bits of investing and making the decisions. For me, this is priority number three because your employer is offering to match your pension. So often employer pensions work differently depending on where you are in the world and what your employer offers. This would need to be checked with the relevant HR department, finance department, or your employer themselves to find out exactly what it is. Often they are invested, and if you don't know how they're invested, I would urge you to go and check it. The reason why I've put this in third position is because usually, if you turn down that employer match, they don't give you it elsewhere. It's just you've lost that money. And that's why it's not worth turning down that pay rise. It's also there because I think preparing for your future and your retirement is absolutely key to any form of financial security and financial success. So even if you feel that that match part, i.e. what you're putting in, is a little bit tough, or you feel that you could get more elsewhere, then we'll come on to that later. Step 4 is destroying any sort of high interest debt. And believe me, I toyed around whether this should go before, for example, the even emergency fund, or whether this should go before that pension match. But actually, it can come in fourth position. Normally, the rule of thumb goes that actually, if the interest rate on a debt exceeds what you could get from investing, it needs prioritizing. And that can help you to start to think about whether the debt that we're talking about here needs knocking on the head before we then start talking about investing into other accounts. So when I'm talking about prioritizing debt, I'm normally the likes of credit card debt, payday loans, mini loans. You get the idea. Now we're getting to the fun stuff. In position number 5 is where we're starting to think about tax efficient places where you can invest. The country you're in will dictate what you have available to you. And it's one thing that I think really needs saying more, but here in the UK and in the US, we are incredibly lucky to have some of the most tax efficient investing vehicles in the world. I've worked internationally as a wealth manager, and so I'm very familiar with what many different countries have available to them. And believe me, there is not much that beats the ISA that we have here in the UK and the system of 401ks, Roths and IRAs that there exists in the US. Canada, Australia and New Zealand have relatively similar or at least comparable pension products. It's worth saying as well that if you're in Sweden, Denmark, France or Japan, you all have some equivalent investing vehicles too that are tax efficient that often are prioritised before then investing on brokerage accounts or without any tax benefits. But it's always just worth checking out the T's and C's for these individual accounts. Coming in sixth position is any extra pension accounts that might also come with tax benefits that you can top up into. Here in the UK, that would look like things such as the SIPP. As I said, in the US and Canada, as well as New Zealand and Australia, we're very lucky to have various different accounts that can be equally beneficial when it comes to pension and retirement savings. I'll caveat this again with there are various T's and C's that come with them, such as lock-in periods. For example, here in the UK, you cannot access that SIPP money until you do turn 55, but it's going up to 57. So make sure that it does align with what you're wanting from that money. But as it's tax efficient, this is the next best place to start investing your money and really growing your wealth. Which brings me on to the next place, because we've kind of run out now of tax efficient accounts. So in seventh position is where you start investing on what we simply call a brokerage account, a general investment account, an investing platform, loads of different terminology that's all used around it. But essentially it allows you to invest into stocks, shares, ETFs and funds and bonds in a way that you will have to pay taxes on it. And that's just kind of part of life. If you're sat in one of the countries that doesn't have one of those tax efficient accounts that I mentioned earlier, you're going to be skipping straight to this step and just investing and accepting that there are taxes associated with it. But normally, growing your money via investing far outweighs the losses. There are still normally efficiencies that can be explored. I'm talking about things like using your allowances. So for example, here in the UK, we have a capital gains allowance and a dividend allowance. Some people will, around tax years, make certain sales, losses, gains and lock them in to be able to try and take advantage of this. This brings me on to the eighth priority, which is normally then overpaying your own mortgage. The reason for that is because often the interest rate on mortgages doesn't exceed what you could have otherwise got from putting money into those investment places that I've mentioned earlier. And then in last place, in that ninth position, it would be alternative investing. This is where you're exploring the world of investing beyond the likes of stocks, shares, ETFs and bonds, and you're moving more into things like unlisted companies, so startups, private equity. You're looking at things like potentially other alternatives, such as investing further into other property. Maybe you're looking at investing into things like art, wine, whatever it might be. These generally come with very few tax efficiencies, but there are some to be aware of. For example, investing into unlisted companies here in the UK, if they are SEIS or EIS eligible, then that may come with certain tax benefits. Now, the reason why this is in the last position is because it is also one of the highest risk categories. And so it's really important that you've prioritised the other forms of investing and tax efficiencies before you move into this, because with the potential for higher growth, can also come the potential for higher losses. And normally, therefore, people want to make sure their foundations are really well set up. So there you have it, the prioritization that I would apply to my financial situation, no matter where I was in the world. And if you have got any questions about any specific tax efficient accounts, drop them in the comments and I'll do my best to answer. Thanks so much and see you at the next one.